Welcome back to the Daily Crypto Roundup. Crypto is having one of those strange days where the price action looks quiet on the surface, but underneath, the industry is changing very quickly. Bitcoin is stuck around the same dangerous area. Stablecoin competition is heating up. MetaMask is trying to turn a wallet into a full financial account. Europe is about to force unlicensed crypto companies into a much harder reality. And one of America's biggest asset managers is taking another step into tokenized finance. So even though the market might feel slow, today is not a slow news day. At the time of recording, Bitcoin is trading around $58,299. Ethereum is around $1,562. XRP is around $1.03. BNB is around $544. Solana is around $72.97. And Hyperliquid is around $64.93. So the mood is still fragile. Bitcoin is not collapsing minute by minute, but it is also not showing the strength bulls wanted to see. Ethereum is still struggling around the $1,500 zone. XRP is sitting just above $1. Solana is holding the low 70s. And Hyperliquid continues to be one of the stronger names in the market, even while the broader crypto space remains under pressure. Before we get into the stories, this episode is brought to you by Kraken. If you are looking to buy, sell, or learn more about crypto, Kraken is one of the most established names in the market. You can check out the Kraken link in the description. As always, nothing in this episode is financial advice. Crypto is risky, prices move fast, and you should always do your own research. And remember, we are giving away 20 XRP to listeners who sign up with our link. Just drop us a message once it's done. Now let's start with Bitcoin, because this is the story that sets the tone for everything else. Bitcoin has been trading in a very tight range around $59,000 to $60,000. And normally, a quiet range is not automatically a bad thing. Sometimes markets consolidate before they move higher. Sometimes boring price action is just the market catching its breath. But the problem this time is where the range is happening. Bitcoin is not consolidating near highs. It is not sitting comfortably above major support. It is hovering below key levels, with analysts warning that the setup looks more like a dangerous pause in a downtrend than a healthy base for a recovery. That is the difference. If Bitcoin had been climbing for weeks and then started moving sideways, people would probably call it strength. But when Bitcoin falls, loses important levels, then goes quiet underneath them, traders get nervous. Because sometimes that quiet period is not the market calming down. Sometimes it is the market loading up for the next move lower. One analyst warned that if this range breaks down instead of resolving higher, the next major area to watch could be around $40,000. Now that does not mean Bitcoin definitely goes there. It means the current structure is weak enough that traders are starting to talk about much lower targets again. And that is important for listeners because crypto does not move in isolation. If Bitcoin breaks down, the rest of the market probably feels it. Altcoins can look strong for a day or two, but if Bitcoin loses confidence, liquidity normally gets pulled away from riskier assets first. There is also another pressure point: strategy. The market is still digesting the idea that Strategy could sell more than $1 billion of its Bitcoin reserves to support its financial position. That is a massive psychological shift, because Michael Saylor built the brand around the idea of never selling Bitcoin. So even the possibility of sales changes the mood. It does not mean Strategy is dumping everything. It does not mean the Bitcoin thesis is over. But it does add supply risk at a time when demand already looks soft. And this is why the current Bitcoin range matters so much. It is not just a chart pattern, it is a confidence test. Can Bitcoin hold this area long enough for buyers to step in? Or is the market simply waiting for the next flush? That is the first big story. The second story is Europe, and this one is about regulation. The European Union's MyCA framework is moving into a much more serious phase, and the latest data shows a very uneven picture. Germany and France are leading the way in crypto licensing, while 5 EU countries reportedly had no MyCA crypto licenses issued as of June 29th. The wider number is important as well. The EU had issued 244 valid MyCA crypto asset service provider licenses by June 29th. Germany had 57 of them, and France had 26. Together, those two countries accounted for more than 1/3 of the total. That tells us something very important. Crypto in Europe is not disappearing, but it is concentrating. The companies that get licensed early in countries like Germany and France could have a real advantage. The companies that do not get approved may have to restrict services, remove products, or stop serving certain EU users. And from July 1st, the transition period becomes a much bigger issue. Crypto firms without the right authorization cannot legally keep offering covered services to EU users. For everyday users, that could mean fewer platform choices, fewer tradable assets, and potentially thinner liquidity in some markets. For exchanges, it means the days of operating across Europe without serious regulatory approval are coming to an end. Now, some people will see this as bad for crypto, and in the short term, it can definitely create disruption. Products get pulled, users get moved around, smaller platforms struggle, big exchanges have to restructure. But the other side of the argument is that regulation can create a clearer pathway for serious companies. Once a platform has a MyCA license, it can potentially use passporting to serve the wider EU market. So this is the trade-off. Less freedom for unlicensed platforms, but more legitimacy for the companies that survive the process. That brings us to the third story: stablecoins. Circle shares dropped sharply after a major new stablecoin network was announced. The project is called OpenUSD, and the backers are not small names. Stripe, Coinbase, MasterCard, Visa, BlackRock, and more than 140 businesses are involved. That is a serious lineup. And the reason this matters is because OpenUSD is not just another token trying to compete with USDC or USDT on branding. It is attacking the economics of the stablecoin business itself. Stablecoin issuers make a lot of money from reserves. When users hold stablecoins backed by assets like short-term US treasuries, the issuer can earn interest on those reserves. That reserve income has become a huge part of the business model. OpenUSD is trying to change that by giving participating businesses a share of the reserve income and removing minting and redemption fees. That is the big threat to Circle. Circle has built USDC into one of the most important regulated stablecoins in the world. USDC has major institutional credibility. But if payment companies, banks, and fintechs are offered a stablecoin where they can share in the economics, that creates a very different competitive landscape. This is not just about which stablecoin traders use on exchanges. It is about who controls digital dollars for payments, merchant settlement, corporate treasuries, and cross-border money movement. And that is why Circle's stock reaction matters. The market is starting to ask whether stablecoin issuers can keep their margins if the biggest distribution partners demand a cut of the economics. This is what happens when stablecoins go mainstream. The competition does not get smaller. It gets bigger, richer, and more aggressive. The fourth story links directly into that same theme. MetaMask has launched a new money account designed to combine stablecoin yield, spending, and trading inside one wallet. This is important because MetaMask is no longer just trying to be where people store tokens or connect to apps. It is moving toward becoming a financial hub. The new account is built around MUSD, MetaMask's own dollar-pegged stablecoin. Users can opt in to earn variable yield of up to 4% by having deposits allocated to decentralized lending protocols, including Morpho, with Aave integrations planned. They can also spend through the MetaMask card at merchants that accept MasterCard. That is a big shift. For years, crypto wallets have been awkward for normal users. You hold assets in one place, trade somewhere else, move funds into DeFi somewhere else, then maybe withdraw to a card or exchange when you want to spend. MetaMask is trying to collapse all of that into one experience. Earn yield, spend, trade, swap tokens, use perps, and interact with prediction markets from one account. That is the direction crypto has to go if it wants real adoption. Not more complicated, less complicated. Not 10 different apps and 5 different transfers. One place where assets can actually be useful. But again, there are risks. Stablecoin yield is not the same as a bank account. DeFi protocols carry smart contract risk, liquidity risk, and market risk. Even self-custody can be dangerous if users do not understand seed phrases, approvals, and wallet security. So the bullish version is that MetaMask is making crypto more usable. The cautious version is that MetaMask is making more complex financial products feel simple, and users still need to understand what is happening under the hood. The fifth story is tokenization, and this one is probably one of the most important long-term stories of the day. New York Life Investment Management, the $807 billion asset management arm of New York Life, is launching its first tokenized fund with Centrifuge. The fund brings a U.S. high-yield corporate bond strategy on-chain, with subscriptions and redemptions settled in USDC. That matters because tokenization is moving beyond the easy first step. The first big wave of real-world asset tokenization was mostly treasury funds. That made sense. Treasuries are liquid, simple compared with many other assets, and easy to explain to institutions. But now the market is moving into other areas: private credit, equities, corporate bonds, and higher yield fixed income. That is exactly what this New York Life move represents. It is not some tiny crypto startup saying tokenization is the future. This is a major traditional asset manager putting a real investment strategy onto blockchain rails. The tokenized real-world asset market is already above $30 billion excluding stablecoins, and analysts from major banks have projected that tokenized assets could grow into the trillions over the next few years. Now, projections are not guarantees, but the direction is clear. Wall Street is testing what happens when traditional financial products can be issued, settled, and moved using blockchain infrastructure. And this is where today's whole roundup connects. Bitcoin looks weak in the short term. Regulation is tightening in Europe. Stablecoin competition is exploding. Wallets are becoming financial accounts, and real-world assets are moving on-chain. That is the contradiction of crypto right now. The price chart looks tired, but the infrastructure story is getting stronger. And that is why investors need to separate two things. Short-term, Bitcoin can still fall. Altcoins can still get hit. Liquidity can stay weak. Regulation can disrupt platforms. And people who chase every bounce can still get punished. But long-term, the direction of travel is obvious. Stablecoins are becoming payment infrastructure. Tokenization is becoming part of institutional finance. Wallets are becoming consumer financial apps. And regulation is forcing crypto into a more formal structure. So the question is not whether crypto is dead. The question is who survives this transition. Because the next phase of crypto may not look like the last one. It may be less about random hype and more about stablecoin rails, licensed platforms, tokenized funds, wallet-based finance, and institutional infrastructure. That does not sound as exciting as a meme coin going up 50x overnight. But it is probably more important. So today's message is simple. Do not ignore the risk in the market. Bitcoin is still sitting in a dangerous area. If it breaks lower, the pain could spread quickly. But also, do not ignore what is being built while prices are weak. Major payment firms are fighting over stablecoins. MetaMask is turning the wallet into a money account. Europe is forcing licensed crypto into the mainstream. And New York Life is bringing high-yield bond exposure on-chain. That is not a dead industry. That is an industry growing up under pressure. Make sure you are following the show. Check out the Kraken link in the description and let us know what you think. Is this market setting up for a deeper crash, or are we watching the foundation being built for the next major crypto cycle? As always, this is not financial advice. Thanks for listening, and we will see you at the top.